everyone. It is Wednesday night, 8 p.m. Eastern, which can only mean one thing. And that one thing, of course, is the weekly darts league at the Elks Lodge. Just kidding. It is Taxes in Retirement Live. I am your host, Andy Panko, moderator of the Facebook group Taxes in Retirement Live and owner of Tenon Financial. Thank you all for joining me. Tonight's topic will be all about doing charitable donations, but specifically the how to do it most tax efficiently, how to maximize the tax benefits of doing charitable donations. Give some people some time to roll in here. And I had a thought as I was listening to that intro video play. I thought it'd be really cool if I can do something different besides the that pre-canned generic song that I picked. Now, if this was a higher budget production, maybe I'd pay for some real music. Like I was thinking Ozzy Osbourne's Crazy Train or something would be a wicked good intro, or maybe something a little more fun like Wham, or I don't know, Culture Club, or I don't know if it was slow it down a little bit like the Commodores. Easy like Sunday morning, Sail On. The song makes me cry. I don't know why. I don't even know what it's about. It's just such a lovely song. But anyway, I will move on. I'd like to get some different intro music, but we'll see. That's I need a bigger budget for that. Let me just see. Comments are working very good. David Fultz, howdy. Again, David Fultz with the one word full sentence, puts a period after it. I love the punctuation. Thank you. All right. Before we start, as you know, let me do the dad jokes. Got some good ones for you. Let me go back here for a second. All right. So, how did the hacker escape the police? He just ransomware. Ransomware. Let that soak in. So my son says to me, and I have a son. I have two daughters, but play along for the sake of the joke. Dad, can you explain solar eclipses? I reply, no, son. And last but not least, everyone knows where the Big Apple is, but does anyone know where Minneapolis is? Minneapolis. Don't know where it is. All right. That kid was delayed laughing because that last one was terrible, absolutely terrible. What is this show coming to? Okay, before we get into it, remember this video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. I am just some fellow here tonight in a maroonish colored shirt talking about how to give money to charities and how to do so tax efficiently. This is general hints and education. Okay, moving on. I'm too young for the Commodores. I guess so, but they had quite some hits. I even post Lionel Richie. Now he's a star in his own right. I love his stuff, but like Night Shift, come on, that's a banger of a song. I didn't have Lionel Richie, and they're still putting out good stuff after him. Anyway, more money, more problem. Oh, definitely. Yeah. Jackie, funny you say this. So I'm active in LinkedIn, just like messing around and goofing around and making friends with other advisors. And I frequently cite Mo Money, Mo Problems as financial advice, which is quite funny. Thank you. Yes, I got a haircut yesterday. After more than a month, my haircutter guy was away for 2.5 weeks in Sicily, and I was away a week before that, and it just didn't work out. And it was getting wild. But yeah, thankfully, it is cleaned up. Okay, enough of it. You didn't come here to hear me talk about Lionel Richie and P. Diddy and my haircut, so I will get into charitable gifting, charitable donations. I do have some slides I will bring up. Now, I should preface this by saying I'm sure you all are going to have questions that I do not know the answers to. This is the rules around deductibility and gifts and different charity or charitable organization types are crazy convoluted. The slides I have, I think, will answer the vast majority of your questions, and it's probably enough content and info for the majority of you all, but nonetheless, there are some hairy, prickly, levels of detail that you would have never thought existed. Anyway, again, I'm not your tax professional. I'm just some random dude here. But if you want more info, you can go to IRS publication. What is this? 526. This is the IRS publication all about charitable contributions, aka donations, if you will. Definitely refer there. This is a surprisingly well-written source. A lot of these IRS publications are actually really well-written, in my opinion, pretty clean and easy to understand. So go there for your questions. I mean, feel free to ask me here, but I'm sure there will be things I don't know, in which case I will be very open about it. So before I pull the slides up, just let me preface by saying yes, there can be some really nice tax benefits to donating things, whether it's cash or securities or cars or clothes or old lamps to charitable organizations. But not to sound crass, but never donate something purely for the sake of trying to get a tax benefit. Unless you actually have charitable intentions and desires to help out organizations, don't give away money just to try to save on taxes. Because even if you save, let's assume your tax rate's 30%, so you save yourself 30 cents on the dollar. Well, if you give away $1 to save 30 cents, you're still out 70 cents, right? So only do this if you're actually charitably inclined. And if you are, then consider the tax implications and how to get the best tax bang for your buck. But don't give away money purely to save tax, because you're still worse off, dollars and cents wise, or less off, I should say. All right, now that that's out of the way, let me pull up my slides. What is that? That's not okay. Here we go. So let me start by, I assume you all know this, so I won't get too deep into it, but when you do your tax return, you have all of your gross income, and then from that, you subtract your deductions. There's other things, but let's keep it simple. You have gross income minus your deductions, and then that's your taxable income, what's left. That taxable income is what's run through the tax brackets we all talk about: 10%, 12%, 22, 24, 32, 35, and I think that's it. So the larger your deductions are, the smaller your tax bill is going to be, all else equal. Now, there's two different types of deductions you can take. There's what's called the standard deduction, which you have up on the screen here. This is simply anyone who's single can deduct $12,500. This is for 2021. Can deduct $12,550, no questions asked. Just boop, shave it right off your adjusted gross income, just like that. To take it a step further, if you are 65 or older, or blind or disabled by the end of the year, you can take off an additional $1,350 on top of that $12,550. So that's if you're single. If you're married, you can see here for a married couple filing joint, it's $25,100. I got that backwards. I'm sorry. Step back a little bit. If you're single, 65 or older, or blind or disabled, you can add another $1,700 to your $12,500 standard deduction. If you're married filing joint, it's $25,100 plus $1,350 per person in the couple who's 65 or older, or blind or disabled. And then if you're head of household, it's $18,000 and change standard deduction. So that's one form. Remember, I said there's two different ways you can deduct. One is take your standard deduction. The other is itemized deductions. Now, that is where you can break out a bunch of different individual things that you're eligible to itemize, to the extent the sum of all those itemized things is larger than your standard deduction. Then you're going to want to deduct your itemized deductions, because that'll give you the smaller amount of taxable income. Why do I say this? Well, prior to 2018, before the Tax Cuts and Jobs Act went into place, standard deductions were half the amount they are now, approximately half. And there was more things you were able to itemize at the time. So pre-2018, I don't have statistics, but a fair amount of people were itemizing deductions versus taking the standard. Since 2018, the vast majority of people are using the standard deduction, itemizing. I want to say it's over 90%, if not 95, if I remember correctly, percent of taxpayers take the standard deduction. Why does this matter? Well, your ability to donate what you give to charity is one of those things that are part of your itemized deductions. So unless your charitable donation plus your other itemized deductions are relatively large, they're not going to exceed your standard deduction, in which case you don't really get any direct benefit for making those deductions, because you can just get your standard deduction regardless. Anyway, I'll leave that there for now. As tax legislation stands now, these standard deductions are set to revert back to their pre-Tax Cuts and Jobs Act levels in 2026. May get changed sooner, who knows? Tax legislation is always subject to change, especially now. There's definitely a push to modify some substantial parts of the tax code, but this is what they are as of right now, and until 2026. And the standard deduction amounts tick up a little bit every year with inflation, but this is what they are this year. Okay, moving on. So how much can you actually deduct? This is where things start to get a little hairy. It all depends on what you're donating. If you donate cash to a qualified charitable organization, and then let me step back. If you look at the top here, it says The deductibility limits for deductions to donations to most types of qualified organizations. So there's a whole slew of different organizations that qualify as charities, churches, synagogues, mosques, the typical not-for-profit organizations like Red Cross, like March of Dimes, like I don't know why I'm drawing a blank. Any of the hundreds of mainstream charities, St. Jude's, that we've all heard of and come across, American Cancer Society or Foundation, not-for-profit educational institutions, some government organizations, fraternal societies, and war organizations like VFW halls and things like that. Universities, right? These are all qualified charitable organizations. However, a small subset of them have reduced deductibility, or may have reduced deductibility limits. So things like, public schools, universities, the big charitable organizations, again, Red Cross, March of Dimes, whatever, St. Jude's, churches, synagogues, religious organizations. These are all what I'm referring to here. The fraternal societies, I forget the exact wording, but like the war remembrance organizations like VFW, those could have slightly different deductibility limits here. So I won't discuss them here, but just know this is part of the complications and part of why you'd want to look at publication 526 if you have specific questions. Anyway, so if you're donating cash, and by cash that can mean actual physical bills, it could be check, it could be credit card, a bank transfer, ACH transfer, you can deduct typically no more than 60% of your adjusted gross income can be deductible for a cash contribution. Now, under the CARES Act, which was the coronavirus relief legislation put in place last year, and it was extended to this year, you can actually deduct up to 100% of your AGI for cash contributions. Assume it won't make it past 2021. So starting next year and forward, assume cash contributions get capped at 60% deductibility for AGI. Now you may ask, what happens if your donation exceeds your deductibility limit? Not to worry, the amount that you couldn't deduct this year carries over and can carry over for up to 5 years. So you just got to plan accordingly. If you're making massive donations such that you can't deduct them all in 1 year, just know that you have 5 years, at which point then it's use it or lose it. If you don't deduct it by then, it's, you lose a chance to deduct it. Capital gain assets. So these are things like stocks or bonds, traditional financial assets, specifically those that its current price is more than the price at which you bought it or otherwise acquired it, and you've held it more than a year. So if you were to sell it, it would be a long-term tax as the gain will be taxed as a long-term capital gain. Why does that matter? Well, the deductibility here has its own kind of bifurcated rules. If you are deducting the fair market value or simply the current price or value of that position, you can deduct no more than 30% of your AGI for that donation. If you instead deduct at your cost of that position, the price at which you paid for it or acquired it, you can deduct up to 50% of your adjusted gross income. Next type of asset is ordinary income asset. Still think of this as traditional financial assets, stocks, bonds, mutual funds, whatever. But the difference is if you were to sell it, it would be a short-term gain. So the gain on it, you've had the position less than a year, or up to a year actually, but no more. In which case it's called the ordinary income asset. The deductibility is 50% of your AGI, but you have to deduct that at its cost, not its current value. And then other property, these are financial assets whose value is less than what you bought it for. So like a stock, bond, or mutual fund where it's dropped since you got it, that would be considered other property. And then literally other property, tangible things, clothes, home furnishings, automobiles, stuff like that. I put an asterisk next to this because generally the amount of deduction is 50% of its fair market value, 50% of AGI for the fair market value of what you donated. However, using automobiles as an example, the deductibility rules around that are that typically when you donate a car or a boat to 1-800 car for kids or whatever it is, or is it 800 or 888, whatever. Places like that usually turn around and sell it. They don't keep these old cars and fix it up. They just take it, sell it. They use the cash for whatever their charitable cause is. In that case, the amount you can deduct is the lesser of the value at the time you donated it or what the organization sells it for. So they will give to you a form 1098-C showing the value of the sale at tax return time. That's the most you can deduct, not what the car is worth, what they actually sold it for. So that's why I said it. It's up to 50% of fair market value. These other things are at fair market value, like clothes, like housewares. That's half of the value at the time you donate it. Cars are a little different, as are some other things. Okay. I will move on. So I see there's some good questions coming in. I'll try to just, run through my bit here and then save questions to the end so as to not break up the flow too much. Next, so let's just run through a quick example. This is non-2021. Show cash. Like if you're going to donate cash, again, for cash for this year, you can deduct up to 100% of your AGI, but let's assume we're in normal years. You can only deduct up to 60% of your AGI. So let's assume you have an AGI of $100,000. Here's where your 60% deductibility limit would happen. And what if you donate $70,000 in cash to Red Cross? I'm going to keep saying Red Cross just because I'm not recommending that. It's not saying it's my charity of choice. It's just the first one that keeps coming to mind. So let's assume you donate 70 grand cash to Red Cross in a normal year, not in the 2021 year. You can, even though you can donate as much as you want, you can give them 10 million bucks, but if your AGI is $100,000, you can only deduct up to 60% of your AGI or $60,000. So again, you can give 70, but you're only deducting 60. This other 10 grand, can't deduct it this year, but you can carry it over and deduct it next year. You can, if you have really large donations next year as well, such that you hit your limit, you can keep carrying over. But again, it only carries over for 5 years, and then it's use it or lose it. What if you're donating multiple types of things, not just cash? So you're donating some cash and you're donating some, some securities, let's say. So now, what if? Here's the different limits. There's a 30% limit, a 50%, and 60%. You donate 40 grand in cash. Cool, no worries, because cash is under the 60% of AGI limit. And I should say the way these things sort of stack is that it starts with the highest deductibility percentage asset. So if you're giving both cash and securities, let's say, you start with your cash in terms of filling up these brackets because you start with the highest percentage asset. So cash can be deducted up to 60%. Securities are only 30 or 50%. So we start with the 60. So you donate 40 grand in cash. No worries, that's under 60%. But look, you crowded out your 30%. So now you can't donate any of those capital gain securities at their fair market value because those had deductions limited to 30% of AGI, of which we're already over. But if you wanted to, if it makes sense, keep in mind there's also that 50% limit for capital gain assets if you deduct it at its cost, not its fair market value. So point is there is still some room to deduct up to another 10 grand more of other assets before you hit this 50% of AGI limit. At that point, you're done. You can't deduct anything else donation-wise. Make sense? Or makes sense enough, hopefully. All right, so now this was just my basics of understanding donations, charitable donations, what they are, how the deductibility of it typically works. Now I have five tips, educational bits about ways to donate tax efficiently. One is bunching donations. So as I mentioned before, especially since 2018 up through now and up through 2026, perhaps, standard deductions are quite large. Itemized deductions are quite small, especially in high cost of living areas where a lot of people in New York, New Jersey, Connecticut, California, places with high property and or state tax, they used to have large itemized deductions, tens of thousands of dollars of itemized deductions on their tax returns. Well, guess what? As part of the Tax Cuts and Jobs Act, those state and local taxes, otherwise known as SALT, S-A-L-T, state and local tax, were capped at $10,000 in aggregate. In New Jersey alone, it's easy to blow through $10,000 just in property taxes, let alone income taxes. So point is, that's one of the big reasons why a lot of people are no longer itemizing deductions, because itemized deductions got squeezed lower, standard deductions got doubled. So a lot of people are standardizing. So let's just walk through a quick example without bunching to see what bunching means. Let's assume you have, here's your itemized deductions, what they would be hypothetically. This is for a married couple. You hit your full $10,000 of state and local property tax deductions. Let's say you have a house with a mortgage you can itemize, and you paid $7,000 of interest for the year. You can itemize that. And let's say you made a $5,000 donation to your favorite charity. You would have $22,000 of itemized deductions. Sounds good, right? But wait, recall for a married couple where everyone's under 65 and not blind and not disabled, the standard deduction is automatically $25,100. So guess what? When you file your taxes, you're taking this. This is better for you. This is a larger deduction amount. Good. Unfortunately, that means you get no unique benefit for having made this charitable donation every year, for 5,000 years, because you're going to keep using your standard deduction. Whether you made this donation or not, you're still deducting $25,100 because of this fat standard deduction. What if instead of giving $5,000 every year to your favorite charity, you bunched them? So instead, every 3 years, you're giving $15,000. So, on the year you do the bunching, you still have your $10,000 state and local tax itemized deduction. You still have your $7,000 mortgage interest. And once every 3 years, you're doing a $15,000 donation to your favorite charity. In these years, your itemized deductions are now $32,000, which is almost $7,000 larger than your standard deduction. Yay. So now in this particular year, you are going to itemize your deductions. You're going to reduce your taxable income by $7,000. Very good, right? Now, the other 2 years where you're not bunching, you're still going to end up taking the standard deduction just like you would have anyway. But you're no worse off because you would have taken the standard deduction every year as it was if you continued making only $5,000 a year in donations. By bunching those donations to make one larger donation every 3 years, in those every 3 years, you're benefiting by a larger itemized deduction, hence saving yourself some tax. That's tip number 1, bunch donations together. Everybody good? Moving on. Tip number 2. Why is this not moving? Tip number 2, donor advised funds. This sort of ties in with bunching. It very closely ties in with bunching. But what is a donor advised fund? So let's step back and go to the bunching idea. What if it's a relatively small charity that's near and dear to your heart, and they run lean and mean, and they need that $5,000 from you every year? If you were to give them $15,000 every 3 years, for whatever reason, maybe they're going to have some operational difficulties, or they can't manage their finances well, or who knows, whatever. Maybe they're adversely impacted by you donating a big amount every 3 years as opposed to a small amount every year. So that may make you be hesitant about that bunching idea, where there's a fix to that, or a possible fix to that. One is what's called the donor advised fund. Donor advised fund is, in effect, it's a investment account. It's in effect its own charitable organization, if you want to think about it that way. You donate cash or securities into the fund. When you make that donation, you get it's a deductible donation to you at the time you make it. That's this. Once the money's in the fund, you can invest it in typical stuff: stocks, bonds, mutual funds, exchange traded funds. You can let it stay there. You don't have to turn around and dole it out to the charities right then. You can let it sit in there for multiple years. And then at your discretion, you can say, okay, even though I put in $15,000 to my donor advised fund now, I want to trickle it out. I want to make a $5,000 distribution to my charity this year. Next year, make another $5,000. Next year, make another $5,000. So this kind of cures both things. It gives you the benefit of bunching because the money you put in, you get a deductible donation for in the year you do it, and the charities get the benefit because you can still dribble out this money, steadily over time, as opposed to giving them one big fat lump every few years. Some other things to consider with donor advised funds: they're not free. It costs organizations that set up and administer these money to do it. Schwab has a donor advised fund platform. Fidelity does. There's independent ones called AEF. I forget what it stands for. Vanguard does, I believe. The cheapest fee I've seen is they charge 0.6% of assets per year on these things. So just orders of magnitude. If you put $100,000 into this, 0.6% per year is going to be, what is that? $600 per year? Did I do that right? I think I did that right. Yeah, $600 per year. Now, not that that's a lot of money by any means, but just realize that it's not free to set up and use a donor advised fund. So if you're going to do it, and some of these do have minimum fees. So, if you put only $1,000 into it, they're probably not going to accept it in the first place. But if they do, there's going to be some minimum level of annual fee. I forget what it is. I want to say it was like the ones I looked at was $500 a year maybe for AEF. So point is, you don't do a donor advised fund if you're putting in $5,000. You know, this is meant to be used tens of thousands of dollars typically, you know, if not some more. iGift fund, I see someone said, yeah. So thank you, whoever said that. That was the other one I was thinking of that's independent from the custodial platforms, the major custodial platforms. Anyway, so that's a donor advised fund. It's not really a tip by itself. You kind of bundle this. That's a bad idea. You kind of couple this with the bunching idea that I mentioned. So you can still kind of parse out your donations steadily over time as opposed to just one big fat one. Cool. Makes sense. Okay. Third tip, qualified charitable distributions. What is this? Otherwise known as QCD. This is when you take money directly out of your traditional IRA or SEP or simple IRA and donate it straight away to a charity. The important thing is it goes straight away. You do not take a distribution into your own name, into your own personal account. No, you instruct your IRA custodian, send money straight to, again, Red Cross, I'm going to say, and they'll go ahead and do it. The benefit, you have to be 70 and a half or older to actually do this. So for those of you who are 40, 50, 60 watching saying, ooh, this sounds good, can't do it, unfortunately. You need to be 70 and a half at a minimum. You can do up to $100,000 per person per year in QCDs. So if you're married, each you and your spouse can donate $100,000 respectively from your IRAs. The big benefits of these is that the amounts you donate by way of QCD do not show up in your AGI at all. So it's not that they don't get a tax deduction. It's even better. They don't even hit the top line of your income. It just simply leaves your IRA as if it was never there. And it doesn't, the other benefit is normally once you're 72 or older, you're going to have to take required minimum distributions from your account every year, from your tax deferred accounts. And there normally aren't ways to get around that. Typically, if you are of RMD age, the first dollar you take out, or every dollar you take out first needs to satisfy your RMD, and then you can do as you please with subsequent amounts. Like conversions, for example, if you're 72 or older, you can't convert away your RMD. If you have an RMD of $20,000, you have to distribute out $20,000. Then you can do conversions above and beyond that, but you can't like do a $20,000 conversion in lieu of taking your RMD. QCDs are an exception. You can, if you have a $20,000 RMD, you can skip it and instead donate 20 grand or however much you want, but you can donate the full 20 grand straight away to a charity by way of a QCD that will erase out and waive your RMD for that year. So it's good for you if you're charitably inclined because you get to give money to charity, and this is the most tax efficient way I can think of. I don't know if there's a better way to give money away if you're 70 and a half and older than to give it straight out of your IRA by way of a QCD, because it doesn't show up in your AGI at all. That also means it doesn't impact Medicare surcharges like IRMA. It doesn't impact anything else in your tax return that flows downstream and is keyed off of your AGI, which is a lot of different things. So there may be scenarios I'm not thinking of, but my understanding and belief is that if you're 70 and a half or older and charitably inclined, all of your donations should likely be in the form of a QCD, unless you have. I'll get to this next topic, but cash donations at least. Yeah, QCD is. I'm struggling to come up with a way that's better tax efficiently than doing a QCD for cash donations. Next. And I see a question here. I see Dave Myers responded as well. So someone asking QCDs be done from a 457. And the answer is no. Currently, no. It's only from IRAs or SEP or simple IRAs. And I think Roth IRAs as well. But frankly, that's not the best way to do it. If you have any sort of tax deferred or taxable account money, it's going to be better to donate that as opposed to Roth IRAs. But in theory, I think you can do a QCD from a Roth IRA. I don't know why you would from a tax efficiency point of view. But no, not employer plans. There is pending legislation called the Securing a Strong Retirement Act, I think it is, where one of the multiple things proposed is not only bumping up RMD age to 75, but one of the other proposals is making QCDs allowed from employer plans like 401ks, 403bs, presumably 457bs. But for now, no, it's solely IRAs where you can do this. Next, donating appreciated securities. So this is only in the context of a regular taxable brokerage account. not from a qualified account like an IRA or a Roth IRA. So if you have a regular brokerage account, and you're charitably inclined, and you have some positions in there you don't necessarily want, or you have things that have large gains, like you bought shares of Microsoft 30 years ago, and now you have bazillion% return on it, and if you were to sell any of it, you're going to have some gains. There's a few things you can do with it. One is you can take it to the grave, pass it on to your heirs, let it get stepped up in basis. But step up in basis is one of the things that are potentially on the chopping block, not to be removed wholesale, but at least be amended perhaps. TBD how that plays out. But in the absence of that, if you have a position you don't want, you can donate it. By donating, you don't have to worry about the gains on it. You can take that appreciated Microsoft stock, just give it to a charity, wash your hands of it. You don't have to pay tax on the gain. Neither does a charity, because charities don't pay tax in the first place. Everybody wins. So this can help you if you have a lot of concentration to one stock. This can help you, get rid of it in a tax efficient way. If you have positions you simply don't want, this can help you get rid of it in a tax efficient way. Just keep in mind, not all charities are actually set up to take in securities, to take in brokerage assets. They need to be affiliated, or not affiliated, but they need to have a relationship with some sort of brokerage firm that has an account set up for them. Now, some of the smaller local charities, probably not robust enough operationally to have a brokerage arrangement in place. So you may not be able to give securities to your local mom and pop charity. They'll gladly accept cash, but typically the larger, more built out charities are able to accept in securities. So you have to check with them how to do it, and then check with your broker where your securities are, what their process is to actually transfer it. It should be fairly straightforward. And we already went over this, but just keep in mind that there are lower deductibility limits for giving appreciated securities as opposed to cash. Again, I said cash, you can deduct up to 60% of your AGI in normal years, 100% of AGI this year and last year, but that's old news. When it comes to securities, you can only donate typically 30% of it if you're deducting its fair value, or 50% of it if you're deducting its original cost. So anyway, keep that in mind. So that's one way to do it. And the reason why I said this only applies to regular brokerage accounts is because in IRAs or Roth IRAs, you don't pay tax on the stuff while it's in there. In IRA, it's a case of IRAs, you pay tax on the money when you take that money out. It doesn't matter what securities or what happened inside the account while it was there. Every penny that comes out is taxable just the same, unless there's basis in it, but that's a different angle, not to further confuse things. And I see another comment here. You can fund a donor advised fund with securities. So if you want to bunch securities, if you want to couple together a bunch of these strategies here, you want to do bunching of your donations, you want to open a donor advised fund, you want to get rid of some securities you don't want, guess what? You can do all three in one shot. You can take a bunch of your appreciated securities, use them to open and fund a donor advised fund, and you can do one big fat donation in 1 year, so you get a really large deduction for that year. Right. And then in subsequent years, maybe you don't donate as much, if anything, if you're following this bunching idea. And finally, the last thing, relatively small in the grand scheme of things, but unique to last year and this year, is, remember I said at the start of this, if your standard deduction is larger than your itemized deductions, you're not going to get any direct unique benefit from your charitable donations, because your standard deduction is going to be whatever it is anyway, regardless of the relatively small amount you donated. Well, this year and last year is an exception, thanks to the CARES Act, again, the coronavirus relief initiative from last year. If you take the standard deduction, you can still get a deduction of up to $300 per person. So if you're married and file a joint return this year, you can do $600. Last year was different. Last year was $300, even if it was a married return. This year is different. If you're married and file a joint return, you can do $600. So you can still deduct up to $600 if married, $300 if single, but only for cash contributions. So let me back up again. You're still taking the standard deduction, but in addition, you can deduct up to $300 if single or $600 if married filing a joint return for cash charitable contributions. Make sense? So this doesn't move the needle tremendously, but hey, a few $100 is a few $100. If it can save you, if you're in the 20% tax bracket, that's what? That's $60 or $120 of tax. That's not bad. Anyway, okay. I think that's all I have for slides. yes, that is all I have for slides. So I will stop the screen share there. I will take whatever questions y'all have about charities. I'm just going back, scrolling through the comments here. What's next year? So someone asked for next week, may I send you an example regarding multi-year backdoor Roth contributions from non-deductible traditional IRAs and any 5-year rule issues? What's next year's topic? I don't even know. If it's relevant to next week, if it's relevant to next week's topic, sure. If it's a mailbag, yeah, definitely. But yes, you can DM me and message me offline or whatever. All right, what else we got here? David Fault says the larger standard deduction contributed to a reduction in charitable giving. I don't know. I'd be curious to see if anyone has pieced that together. I would suspect it. My guess is it has somewhat, but that's just pure educated guess. I really don't know. Oh, it looks like someone may have responded here. Yeah, it looks like it may have argued somewhat. Yeah, okay. Or it may have declined somewhat. Okay, cool. What else do we have here? Yeah, so it could have been skewed because a lot of people probably jammed in donations in 2017 before the Tax Cuts and Jobs Act took place. So maybe they just kind of front loaded, pulled some 2018 and 19 donations that they otherwise would have made into 2017. QCDs are a huge deal for most folks over 70 and a half, better than deductible contributions anyway. Exactly. I fully agree with that. Again, there may be some instance where traditional deductible contributions are better, but I'm struggling to process in my head how that can be, because when QCDs come right off your AGI or don't even hit your AGI in the first place, that's even better than getting below line tax deduction. Yep, and this person just mentioning what I just said about the Special CARES Act thing. For carryover donation, if you use a standard deduction the next 4 years, can it carry over to the 5th year when you itemize it again? That's a good question. I don't know. I don't think so. I think it's flat out 5 tax years, period. So if you don't get the benefit, let me think about this. Unless you have a really small AGI, Teresa, I'm inclined to say if your donation was so big that you weren't able to carry it all over, I mean, that you weren't able to use it all and had to carry it all over, chances are the absolute dollar amount of that carryover should be fairly big. And again, unless you have a really tiny AGI, for multiple years going forward, I want to think that the amount of carryover is hopefully bigger than your AGI is. I'm sorry, bigger than your standard deduction is. So I'd like to think that you wouldn't simply lose it because standard deduction's high. I haven't thought this through before, but unless your AGI is consistently really low, that may be the time where you do lose after 5 years because you keep taking standard deductions. That's a great question. Yes, this was the AEF I referred to, that donor advised fund platform. What's cool about them is, unlike the Schwab or the Fidelity platforms where you have to have your fund, your account at Schwab or Fidelity, American Endowment Foundation is agnostic to what custodian you use. They're just a third party that does the administration and running of the fund. But if you work with an advisor or you manage yourself, you can open up the fund itself at different brokerage accounts, different custodians, and AEF is just a third party that oversees the comings and goings and administration of the charitable aspects of it. Okay, what else do we got here? Teresa Wood above. Well, let's see what Taylor Meyer says. Small additional magic benefit of a donor advised fund. Donations to end charities can be anonymous or not have all your contact info. If you love the charity but don't want them hounding you for money forever. Yeah, it's cool. I didn't think about that, but that's a good point. Anytime I hear of a quick sidebar, anytime I hear of an anonymous donation, I always think of Curb Your Enthusiasm. I don't know who all watched that, but there was an episode where there was some new wing of a museum opened up, and Larry David was one of the big contributors, and he did it as anonymous, and he showed up at like the opening gala to celebrate this new wing. And there's a big thing that said like donated by anonymous, and he was walking around the crowd like, I'm anonymous, like telling people he didn't want to be known, but he wanted to be known. He didn't want to be known. Anyway, that's what I think of when I think of anonymous donations. Teresa, above the line CARES Act donations in Idaho, some charities, education, youth rehab, have state rebates up to a limit, so they're extra helpful. Okay, good to know. Yeah, state tax, man. So everything we generally talk about in this group is in the context of federal taxes, which aren't necessarily easy, but at least they're consistently applied across everyone. We also have to always remember state taxes to the extent it comes into play. Like states that don't have income tax, not that big of a deal necessarily, even though they still may have like inheritance tax or estate taxes, even without income tax. But for the vast majority of states, those that do have income taxes, yes, you always give consideration to the state implications of these things as well. By default, I'm just talking about federal taxes whenever I'm up here talking about all this stuff. Another donor advised fund benefit. My ex-employer's foundation does a one-to-one matching. The donor advised fund sends me a notice of donation pretty quickly that I can submit to the foundation, which they readily accept. No hounding the charity for a donation receipt. Good to know. Man, not a hot topic. It's only 40 minutes in. Looks like we're done here with questions. Wow, come on, guys. Qualified charitable distribution, if charitably inclined, would say you should not convert all funds from traditional IRA to Roth. Keep enough behind for untaxed donations. Exactly. This is another one of the reasons, of which there's a few reasons why you don't necessarily want to convert away all of your tax-deferred accounts. Because if you are charitably inclined, as I mentioned before, doing QCDs is almost certainly the most tax efficient way to give cash, at least. So if you do plan on having, some sort of kind of charitable gifting plan in your life as you age, it's good to have money in your tax deferred accounts, assuming it's an IRA, because you can do these QCDs. And again, charity gets the benefit of it, and you get the most tax efficient use of that money. All right, looks like that might be it. I will hang out for another couple minutes and ramble about whatever. Maybe I'll start talking about the Commodores again, or Neil Diamond. I'm a big Neil Diamond fan. I thought about, it'd be cool if I can get some of his intro music, but that's not really upbeat. I mean, Cherry is kind of fun. Sweet Caroline's all right, but that's too played out. You go to any bar and play that, and people do the da thing. I don't like that. I'm a Neil Diamond purist. I like stuff like Kentucky Woman, I Said. The song makes me cry as well. Play Me is a great one. Oh man, Love on the Rocks. Ain't no surprise. Thank you, Dave Fultz. Yeah. Anyone else help me? Because I'm going to keep talking about random musical references here. If we don't, and I'm sure the rest of you are going to be zoning out. Who knows? Maybe that'll be more interesting to you all than this stuff. Okay, here we go. Mary Sherwin. Does the IRA custodian report QCD on 1099, or do you track it yourself? What kind of fees do you incur? That's a good question. I forgot the answer to this, to be honest. I did look it up and knew it earlier in the year. There is a special note you need to make on your tax return. So on the line on the 1040 that says gross IRA distributions, your QCD amount will be included in that gross amount, but your tax return prep software, if you do it by hand, you write it in. If I remember correctly, I think you write QCD next to it, such that the taxable amount of that distribution will be less than the reported gross amount by the amount of the QCD. Assuming that's all you got going on. If you got other things in your IRA, it's gonna fudge the numbers, muddy the numbers. But if it's just your QCD, that's gonna be the difference. You do report that on your tax return. Now, does your 1099 look any different? I frankly don't remember. I want to say logically, yes, it does. It should, but I forgot the answer. Great question. If anyone knows, I feel like Dave Myers, this is something you may know. Oh, hold on. Dave Myers beat me to it. They report it as part of your 1099 and does not distinguish it. So you need to clarify. Okay. So yes, I don't remember that being the answer, but maybe it was. Okay. So it's up to you to track it, Mary Sherwin, assuming what Dave Myers says is right, which I don't doubt it. Dave Myers is an absolute oracle. It's on you to denote it on your tax return as having done the QCD, because apparently your 1099 will not show anything special. And no, there shouldn't be any fees to it. I'd be surprised if there was. I don't think the large places like Fidelity, Schwab, TD, Vanguard, whatever, charge for QCDs. Definitely ask if they do. Again, I'd be surprised, but if they do, maybe you want to really, if the fee is a fixed amount, like $20 or whatever, then you want to probably donate relatively large amounts. So, on a percentage basis, that fee is really tiny, but I don't think they do. Smaller custodians may possibly, just because, they don't have as much scale and need the additional sources of revenue, but I'm really not sure. Let's see what Cody says again here about QCDs. You report the full amount on a distribution. Yep. On the line for taxable, you enter 0 and you write QCD. Yeah. Okay. So as I was expected, but I guess the 1099, according to Dave Myers, does not show anything different. Okay, cool. So Mary asks, so you can make your donations up to your annual distribution and then call it a QCD in your return. Yes. So going back, Mary, Sharon, let's assume simple numbers. You have an IRA of $1 million. You just turned 72. Your QCD is approximately 3.9% of that million. So you're going to have a $39,000 required minimum distribution. Let's assume you don't want or need any of that money and you don't want the tax impact of it. Yes, you can do a $39,000 QCD if you're over 70 and a half. Well, you would be if you're of RMD age. So never mind. You already meet that age condition. So yes, you can do a $39,000 RMD QCD from your IRA straight to a qualified charity. And yes, you do not have to take the RMD. You're going to have 0 adjusted gross income show up from that distribution. All is good. Great question. I don't know if all custodians provide it. Again, the large ones definitely do. The small ones, I have no idea if they do. Maybe there's a fee. Great question. Is there a mileage deduction or anything else? Oh yeah, this is a good one, Alan Thomas. I didn't mention this. So we just talked about donating cash, securities, clothes, cars, lamps, whatever, books. If you can't donate time. So if you're in a professional service, like you're a lawyer, you normally charge $500 an hour for your services to paying clients, and you decide to donate some of your services to a charity and you work for them for 10 hours, you cannot give yourself a deduction of what's 10 times 500 of $5,000. You can't say, well, I gave them 10 hours of my time that's normally billed at $500. So that's a $5,000 donation. No, you cannot donate the value of your time, period. So there's no deduction for that. If you volunteer somewhere and you drive there, or you even drive to drop stuff off, I think, don't quote me, but I think even driving to drop stuff off at a charity, there is a mileage deduction you can deduct. I forget what it is. It's something less than the 58 or 59 cent, like work-related, business-related mileage. I want to say it's 16 maybe, or am I confusing that with medical miles? You can also deduct mileage driving to and from medical, qualified medical procedures and expenses, like driving to the doctor. You can deduct that mileage as a medical expense. Anyway, you can deduct mileage related to charitable activities. I don't remember what that cents per mile is, but yes, great question. Again, you have to add that to your other itemized deductions, and only to the extent that your itemized deductions exceed your standard deduction do you actually get any tax benefit. But yes, mileage to and fro is potentially deductible. Thank you for bringing that up, Alan Thomas. Jackie, HSA impresario just wants to say that HSAs are a great account to leave to a nonprofit charity. Otherwise, HSAs are fully taxable to the beneficiary other than a spouse. Yes, predominantly true. So yes, charities never pay tax on stuff you give them. HSAs are one of the probably the most tax advantage vehicle there is in your own hands or in the hands of your spouse if you die and leave it to your spouse. The magic benefit of HSAs is tax deduction on contributions, tax-free growth, tax-free withdrawals. Winner, 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 chicken dinner. If you die, you don't have a spouse to leave it to, and you leave it to anyone else, non-charity, that person has to claim all of that account value as income in the year they receive it, and it's fully taxable. There's an exception, and this is where things get a little gray in my mind. If the heir has proof of medical expenses you had before you died that you did not already reimburse yourself from the HSA, that heir can take out up to the amount of those expenses as tax-free distributions. Now, where I get uncomfortable with this idea is, like, practically speaking, how many people are going to have these detailed books of receipts? Maybe some people do, before they pass, they realize they're going to pass and they keep all this stuff. But more importantly, that concerns me is if the IRS comes knocking and asks, how are you going to be able to prove that the person who died did not already reimburse themselves for these various expenses, even if you have the receipts, that they did not already reimburse themselves from the HSA? I don't know if that's possible. Now, maybe the answer is, frankly, the IRS isn't going to care because HSAs aren't drastically large, given the relatively small amounts you can put in it. It's not like someone's going to have $1 million HSA. Most likely, typically they're a few tens of thousands of dollars. The biggest one I've seen so far is like, I want to say 100 something. So maybe the IRS doesn't care, right? Maybe it's going to fly under their radar and not raise any flags. But if they come asking and you claim a distribution for expenses that the deceased had, I'd be uncomfortable with that. So anyway, so yes, your point's largely right, Jackie. It's not always entirely taxable, but assume for all intents and purposes, it is if you're leaving it to anyone other than a spouse. Hence, if you leave it to a charity, the only one who misses out is the government because no one pays tax on it. Yeah, so Dave Myers just saying some custodians do apparently let you have a checkbook with which you can do a QCD. Super slick. Teresa Wood. Yeah, exactly. So yes, a check needs to be made out direct to the charity and definitely not to you. Do not let the check or the money come direct to you unless the check comes to you and the check's made out to the charity. You then turn around and mail it to the charity, but do not have your name on the check. Yeah, another good point from Dave Myers. Unlike some other parts of the tax codes, to do a QCD, it's not the year you turn 70 and a half. You have to actually be 70 and a half, right? So 70 in 6 months at a minimum to do it. If you do it, when you're only 70 and a quarter, that's not cool. Don't do that. What's it? Where did we just go? From EJ Bacon, when making the notation of a QCD and amount on the tax form, do we need to put the name of the charities there too? No, I don't believe so. I think the onus is on you. Like any charitable donation you make, you oftentimes, depending on the size of the donation, you don't have to say who you gave it to, but you do need records that you actually did it. So if you get audited or questioned, the onus is on you to make sure you have the records. But no, just doing a QCD, you don't need to denote the name. So 14 cents per mile for charity. Cody, thanks. I guess it was 16. Not bad. Thank you for that. And that's for 2021. These mileage rates do change or can change every year. Oh, interesting. Okay. Teresa Wood, my understanding is that mileage to and from charity are not deductible, but they send you somewhere from their location, that mileage to and from is deductible. That could make sense. So simply driving to, the local Salvation Army to drop stuff off at their back door sounds like may not be deductible, and that would make sense. But if you're volunteering for them and they have you drive somewhere to do something, or like Meals on Wheels, where you're using your car to drive to and from for their charitable cause, then you can deduct the mileage. Great point. Thanks for looking that up or adding that in, Teresa. What is this? I was looking into opening a donor advised fund. They no longer have a minimum, but still charge $100 or 0.6% fee. I love the idea of only having to keep track of one donation for tax purposes, but I hate the idea of paying a $100 fee. Right. We'll probably just bunch donations for next year and open a donor advised fund. Then we have never taken standard deduction, but this year we will if we don't do any donations. Yeah. Okay. So yeah, $100 doesn't break the bank, but it is kind of irksome to have to do that. I mean, the administrator's got to get paid. There is a lot of work in process, much more so than having a normal brokerage account, if you will. There is work in process, and these custodians haven't run these things. They are charitable organizations, so they're like record keeping, and I'm assuming more process to open and maintain them than there is normal accounts, and that's presumably why they have these fees. Okay. What if you're driving is to and from Habitat Humanity worksite? Is that not headquarters? Yeah, I don't know that question. I don't know that answer. Yeah, I'm not going to. My guess, do not quote me. This could very well be wrong. My guess is that might be okay because like they're requiring you to drive there. Actually, I don't know. Yeah, I'm not going to say that. I really don't know. That's an interesting question though, Alan Thomas. Yeah, if I recall, AEF's minimum fee was $125 a quarter. I want to say that's right, because when I looked into it for a client, the break even was like you need at least $80,000 in there at 0.06%. So what does that equate to? At 0.6%. So it's $480 a year. Yes, exactly. That sounds about right. Yeah. So AEF, that's again the independent donor advised fund platform. I think that's right. Their minimum fee was $125 a quarter. and then it's 0.6% of assets per year, subject to a minimum of 125 a quarter. So doing the break even on that, that's like what's it, 80 something thousand bucks you need to have to $83,000 and change that you need to have in order for the minimum quarterly fee not to exceed 0.6% per year. So again, not in this case, yeah, $500 a year. It's starting to be a lot of money that can otherwise go to charity, but that's the cost of them running this platform. So anyway, all right, looks like this might be it before I start giving any other random wacky musical references. Any last questions from people? Or do we actually wrap this one up within an hour this week? What's tomorrow's topic? I don't even know. Oh yeah, mailbag. Okay, so next week, August 18th, is a mailbag edition. Those are always fun. If you have questions, you can send them to me ahead of time. I have one so far, and then whoever just posted earlier about that conversion question, I think, feel free to send that. Okay, I will leave it there then. We'll call that a wrap. Thank you all for attending. The 40-ish of you who I can see are viewing this. Have a good week. I will see you next week for the mailbag. Take care.